Hey, what's up everyone? This is Silver Slayer. Thank you for tuning into this video. Silver recently did the impossible, the unthinkable. It broke a record that has been held for over 5,000 years. We've never seen anything like this for 5,000 years. It's actually astonishing, and I want to go over this because it truly is incredible that the gold to silver ratio got as high as 124 to 1. This whole article is going to go over the historical background of life, where gold and silver came into play, and why this ratio is just so incredible. So before we start, make sure to smash the like button. Make sure you subscribe because I do post daily videos. So, the gold to silver ratio broke through its former all-time high last month. The gold to silver ratio arguably is the longest running price series in a financial history, some 5,000 years. The US dollar, fiat currency, is a newborn baby compared to the age of precious metals. What factors impact the gold to silver ratio, and what are the remaining implications for investors? So, students of economic history will no doubt have been fascinated to see the gold to silver ratio increase to over 125 to 1 on March 18th, right? This is a piece of history. Right, this is going into the history books, and we're living in crazy times, so expect crazy things to happen, people. Meaningfully above its former all-time high. This is especially the case where the term all-time high shouldn't be taken lightly, since the gold to silver ratio has been arguably the longest-running price series in 5,000 years. So, in 5,000 years, this is the highest we've ever seen it. That's pretty astonishing. This article claims or aims to, 1, provide a bit of useful historical background, 2, briefly sum up the case for precious metals, and 3, consider why the gold to silver ratio is making new highs, and 4, highlight the main implications for investors. Before we get into it, please bear with us as we remind ourselves of a number of key historical milestones for a bit of context as much needed perspective, right? This is going to put in perspective how long ago 5,000 years. 13.5 billion years ago, matter and energy appear, beginning of physics and chemistry. 4.5 billion years ago, formation of planet Earth. 3.8 billion years ago, emergence of organisms. And then it goes down here to 50 years ago, the information revolution. Now, biotechnological revolution. So, 5,000 years ago is the emergence of commodity money, including gold and silver. So, it's also worth remembering the reasons why the broad-based and voluntary adherence to gold and silver as the most suitable form of money occurred. This is summed up by this 1-minute video, which is an extract of Real Vision's 2018 documentary on gold. So, here's the case for precious metals. 1. Own a hard currency as a reserve. Call us sticklers, but for a portion of savings that we hold in reserve for various reasons, we actually care about currencies fulfilling their central functions as money. They are to act as 1, a store of value, and 2, a unit of account, and 3, a medium of exchange, right? Precious metals cannot be created nor destroyed. By far, the most important of these conditions is the first one, a store of value. This means that whatever we choose as money, be it gold, silver, or simply a paper currency, is accepted as legal tender of debts backed by the faith of credit of sovereign government, it must preserve its purchasing power over time. The phenomenon that hinders this from occurring is inflation, or the gradual depreciation of currency relative to the value of what it can be purchased in real money, or in a real economy. So, and now let us remember that the irredeemable fiat currencies have a horrendous track record as a store of value. This should come up as no surprise given that most central banks are mandated to depreciate their currencies. Price stability is typically referring to 2% inflation target. So gold and silver, on the other hand, have adequately acted as a store of value for centuries. For those that understandably require more than just anecdotal evidence, the chart below displays monthly real gold and silver prices in USD between 1915 and April 1st, 2020. In the case for silver, one can observe that more than 100 years into the chart, silver is basically flat from where it started. In other words, it's maintained its purchasing power. See, if you held $50,000 in a bank account and then held another $50,000 in gold and silver, your $50,000 in a bank account would actually lose its purchasing power. What you can buy with it actually depreciates. Maybe you can buy a Tesla right now, but maybe in 30, 40 years you can only buy a Honda. See, the dollar's losing its purchasing power. Gold and silver hold its value. So number 2, create a hedge against the frailties of the monetary and financial system. The second main reason for owning precious metals as a part of an asset allocation is to create a hedge against its variety of what statisticians call extreme left tail risks, including those related to frailties of the current monetary and financial system. So why is the gold to silver ratio making new highs? Now let's get into the crux of the matter. Why does the gold to silver ratio fluctuate over time, and why is it now making new all-time highs? In essence, the gold to silver ratio indicates how much silver it takes to buy gold. When the ratio is high, it means silver is inexpensive relative to gold, and vice versa. Here are a few milestones to remind us the long-term history of the gold to silver ratio. Ratio is 2.5 to 1 in Egypt under Means. And that was 2.5 parts silver equals 1 part gold. Right? That's the earliest ratio we remember. And that's back when silver was seen as magical. It could purify water, the way it responded with other elements. You know, Egyptian salt, it was magical. So it was very, very valuable compared to gold. Ratio is 6 to 1 in Mesopotamia under Hammurabi. Ratio is 12.5 to 1 under Greece, Alexander the Great. Ratio is 12.5 to 1 under Rome and Augustus. Ratio is 15 to 1 in Europe throughout the Middle Ages. In 1792, George Washington fixed the ratio to 15 to 1. FDR, and this is another ratio, it's a stat to throw in there that's not added in here that definitely needs to be. In the 30s, FDR changed the gold to silver ratio from 16 to 1 to 75 to 1. 16 to 1 to 75 to 1. Overnight, FDR did that. Check it. It's real. By the way, I know my stats. I love my stats. A lot of times when these articles say stuff, I'll throw in some other side notes just because I love silver so much. I know a lot about it. Probably too much that I really need to. Actually, no, because I'm a YouTube channel, so I definitely need to know this stuff. But anyways, in short, one can observe the gold to silver ratio has been on a structural upward trend since the very beginning of money, but it remained below 20 to 1 level since the late 19th century. Shot up 40 to 1. In the beginning of the 20th century, it's fluctuated significantly as shown. It reached over 125 to 1 on March 18th before coming back down to 111 to 1 at the end of the month. So look at that. Look at that. That is absolutely crazy. That's absolutely crazy. And you can see in the 30s right here, this is where FDR did that 75 to 1, then it shot back. And it never really recovered since then. I mean, you know, it did somewhat, but you can see like just how crazy the gold to silver ratio has been. Now, what are the main reasons why the gold to silver ratio fluctuates? Why is it so high as of today? In trying to understand the many factors that influence the price of gold and silver, it's useful to remember a number of key differences between the two metals: demand, supply, durability, market size, storage, central banks. So with many of the factors impacting the price of both gold and silver, it probably shouldn't be a surprise to us that the gold to silver ratio can fluctuate widely over time. Some might reasonably argue that it's a pretty useless indicator. I definitely think it's a very good indicator to see which is the better investment at that point in time. Yet there is one factor that seems to correlate to the gold to silver ratio better than most. It's inflation expectations. And by inflation, we are referring to both monetary inflation and its impact on the general price level. This is the thesis expressed by Wheaton Precious Metals, which views the ratio as an indicator of the global monetary condition, according to their analysis. During periods of inflationary monetary proliferation, the ratio falls. During eras of deflationary monetary destruction, the ratio rises. This is also the observation of Marshall Gittler of the BDS Swiss group, when he writes, the ratio tends to rise when inflation expectations fall. And it's almost exactly correlated. So implications for investors: a preface of shortage or real capital, the disinflation, a negative rate of inflation, it's still what still lies ahead. So despite a very rapid correction in the price of equities, we believe that it's balanced. For us, this means that precious metals should definitely play a substantial role in our asset allocation. We favor the physical metal. I've never owned any precious metal in paper form. And that's definitely true as well. You want to own gold and silver in its physical form. You don't want to be buying ETFs. That's pegged to the dollar, which is collapsing, right? So right now, physical gold and silver play a substantial role in the world, the history of the world, and always have and always will be for over 5,000 years. Right now, the ratio may be high, but it still shows how undervalued silver is, which means you better pile up on silver while you can before the ratio normalizes, meaning silver prices will rise. So anyways, I'm going to wrap this video up here. Thank you so much for tuning in. The link to this article will be in the description if you want to check it out yourself. Make sure to smash the like button. Make sure you subscribe because I post daily videos. This is Silver Slayer. Thanks for tuning in. Peace.